When you look at investors and you actually look at how they build their portfolios in today's market, you'll see that they are overweight the United States. And after the United States, the area that they'll consider for exposure is Europe. But all of them feel a necessity to have China in their portfolios. So now, if you were to take out US, which probably could be 60 to 70% of a portfolio, you take out Europe, which could be 20 to 30% of a portfolio, you take out China, that's 5 to 10 of a portfolio, how much is left for all the rest of the markets and economies? And you're looking at probably 2 or 3%. Now, if you exclude government activity in the frontier markets and you're looking at some of the newer markets that are coming, what you then have is a very strong focus on China, right? And China itself, when you're looking again at the constitution of the private equity, you've got some very large funds that between the international funding and the domestic funding, which they do at the same time, are quite substantial in assets. And then you've got a lot of venture and growth activity, which is extremely popular with international investors. When we step away from China and we're looking at the markets outside of the United States and Western Europe in particular, the critical question here is threefold. Number one, can you have controlled mid-market investments? Control is the critical word. Second, what type of currency volatility and potential impact can I have on my net US dollar equivalent returns? And third, is there a political infrastructure that we need to operate within? Because usually when you're working in these types of markets, the first thing that you look at is population. You need to have a critical 100 million plus population. Ideally, the population is youthful and growing in age, and that the government allows bankruptcy to take place and has an infrastructure to be able to do that. And then within that, there's a very solid regulator that has a forward-looking a perspective concerning fiscal, tax, and other type of ownership laws that apply to being able to have control. If you look at, if you want to go and talk about risks, the largest risk that you have in these markets is really currency. Because at the end of the day, the currency can very easily wipe out your profits, and you can't hedge the currency in these markets. So the question then is that risk worth taking? And what you need to try to identify are those individuals that have an X factor. You have those individuals that come from different backgrounds, whether they worked in government, whether they worked in finance, or whether they were entrepreneurs that have become private equity professionals that have an ability to drive alpha, because that's all we want to invest in. We want to invest into alpha-generating private equity firms. The other thing is these markets don't have the scalability for the 20, 30 largest investors in the world to be able to come in. These investors write tickets of 500, and the funds that we're talking about are 350 in size. And these investors normally have a policy of 10% of total size, right? So if you start putting your math together, it becomes quite challenging. If you exclude countries that have very strong local investors, or for some particular reason, those local investors are regulatorily taken out of the country, which recently happened in one of the Central American countries, it is very difficult to grow private equity in these new markets. And the only people that are able to support the growth are the DFIs, the development funds, other governments that have certain plans, and local governments, but not, and you will not see, the institutional investors. I think, the first thing you need to look at is those individuals that have X factors. And you have to be like in economies that have the scalability. So you're looking at large populations. You're looking at good government with good regulations. But it is an individual that's going to make that difference. But the other thing is the individual has to very quickly institutionalize themselves. And that's why in a lot of these markets, when you look at the first generation funds, they've had a very high component of the development banks in there, of the development funds, I should say, and they've been superb in creating ESG, in creating proper governance, and in kind of directing the businesses towards a very, very good direction in terms of institutionalizing this entrepreneurial kind of spirit that emanated from these individuals.